Hi there, welcome to Kneppy Invest and welcome to another answer and reply video where I get to answer your questions and reply to your comments to the best of my ability. And I want to emphasize to the best of my ability because there might be some of you out there who think my ability is severely lacking. And you might be right. You might be right. Anyway, let's go back to just James Dean question in regards to a company called IPH, where I must have mentioned that earnings per share for this company is not increasing, and I just probably want to clarify that. So earnings per share not increasing, question mark, what am I missing? And he calculated the earnings per share to be increasing at 6.45% per year. That's CAGR. And FinChat mentions or states it's at 4.5% per year. So a little bit lower in FinChat than what Just James Dean calculated. So typically, when it comes to a company like IPH, and I researched this company about 2 or 3 years ago because I thought, I'll just have a look at this company. And the thing that really drew me away from IPH was the lack of earnings per share growth. So I'm said there, lack of earnings per share. But what I really mean is I want to see higher earnings per share, than what they have been delivering over the last 5 to 10 years. So last 5 years, 1.7%, last 10 years, 4.5%. So the reason that is important to me is I was wanting to see if I could classify IPH as a high quality company, and I just couldn't because of the lack of earnings per share growth. But back then when I did research on this company, the P ratio was well above 30. And that was a pretty big red flag for me because of lack of earnings per share growth. Now the P ratio of this company is 14.5. So the lack of earnings per share growth is not quite as important. I still want to see it growing, but they can grow at a smaller rate. And this company is still, could be still attractive at these levels because I don't have to grow as quick to justify the valuation. The other attractive thing about IPH right now is a dividend yield, 7.3%. And if this company can continue to grow, and if the company or the market decides to value this company as a high quality company again, like I did a few years ago, you might see the share price take off. You might see a re-rating in the share price. So you could see pretty good capital growth from here. And I'm talking about share price doubling in like a 3-year period. And if the company can keep on growing, that dividend yield on the initial capital will probably get above 10%. So there are definitely some attractive qualities when it comes to IPH right now, just because the share price has pulled back a fair bit. And when I say a fair bit, this is a chart. Share price is still in a downtrend. Share price just decreased a month ago on the 12th of March because I think the CFO resigned. And I think that's probably no reaction from the market. But it wasn't that long ago, the share price was above $10. Did it get above $10? It got very close to $10 in August 2022. So we're talking about less than 3 years ago. So there is definitely potential. The share price could get back up to those levels if the market perception of this company does change. And it could change because it changed within a 2.5-year period. So definitely a company I'm keeping a close eye on just because of valuation reasons. I wouldn't consider this company to be high quality, but I do like the potential returns you might get from this company over the next 5 years if the share price can start going up. Okay, so thank you for that, Just James Dean. Hopefully I've made myself clear. Not consider IPH to be a high quality company, but it is attractive on valuation reasons. And earnings per share is increasing, but not increasing at the rate I would like to see for me to consider this company to be high quality. Okay, so thank you for that, Just James Dean. On to, I think, the winner for most comments or questions I'll be answering today, VBED66. I do want to try to keep it the limit to maybe 1 or 2, but I have a feeling VBD has 3 questions and comments. So congratulations. He's always putting in interesting comments and questions. I do actually gain a bit of insight or get a bit of insight from his questions and comments. So congratulations to VBED66 talking about how a mine in Guinea might destroy MinRes and Fortescue. So there's this absolutely big mine in Guinea. I believe, if I'm not mistaken, it's jointly run by Rio Tinto and a Chinese consortium. I first read about this 5 years ago, maybe even longer than that. And at that point in time, I was thinking, ooh, this is going to significantly affect the iron ore market and probably significantly negatively affect some of the big iron ore players in Australia, particularly the high-cost iron ore miners, which are the smaller companies, not Fortescue, not Rio Tinto, not BHP. Anyway, so I'm pretty sure this is that mine. It's been a while since I looked at it. And it's been a while since I even thought about it. So I'm just going to Google it right now. And there it is. Thank you, AI Overview. I'm assuming this is absolutely right. Is the world's largest untapped reserve of high-grade iron ore, estimated over 2 billion tonnes. So southeast of Guinea, Simandou potential to impact the global iron ore market, and is being developed by Rio Tinto and Chinese consortium. So, VB mentions it's going to go into production soon, I think. Yeah, down here he does say it, yeah. Towards the end of the year. Yeah, start shipping ore at Simandou. So it's amazing. I haven't been thinking about this project for 5 years, and now it's coming into play. And this was one of the reasons about 5 years ago I was not keen on the long-term potential of many iron ore companies on the ASX, including Fortescue, not Rio Tinto, because, well, maybe even a little bit Rio Tinto, because price of iron ore will drop more than likely. Just it's about supply and demand. So if this iron ore project starts really producing a massive amount of iron ore, we see a flux of iron ore on the market. So supply goes up. It will demand meet that supply? Probably not. I don't think demand's going to shift all that much. So supply, extra supply, not lower demand, but maybe a little bit higher demand. So based off supply demand, iron ore prices should go down. And once you see iron prices go down, you'll start to see iron ore mines, particularly high-cost iron ore mines, go into mothballs. And that could lead to the failure of quite a few iron ore companies, including on Australia. And I don't think, I'll be a little bit different to VBD. I don't think this will destroy MinRes and Fortescue, but I will significantly impact those companies. And I think maybe this is one of the reasons why BHP is trying to tell the market they are more than an iron ore company. In fact, if you have a look at their activities report, when they release it in the next few weeks, they will mention copper at the top. They want to be considered more of a copper company, but I disagree with them about that. Anyway, so thank you for that, VBED66. Something else to think about, this massive iron ore mine in Simandou. No, it's not Simandou. It's called Simandou, but it's in Guinea. Anyway, so thank you for that. Some great insight from VBE. Now on to Anmar, about a company I know nothing about. Any idea why Nox is going down because of uncertainty of the clinical trials? I think it's because of something else. I think it's more likely because of negative or overall negative sentiment in the market. Now, I don't know anything about this company, Nox, which I believe is Noxopharm. Let's have a look. Yep, there is Noxopharm. In fact, I had to have a look at this before I started recording, just to make sure it was Noxopharm. Anyway, so I don't know anything about this company. So if I don't know anything about a company, what do I do first? So what I do first is I have a look at the most recent Appendix 4C. You can have a look at the most recent Appendix 4D, but I'll have a look. Usually I will have a look at a company's quarterly report. And the first thing I want to know is whether this company is a storage stock. Does the company have any receipts? And the answer to that is no. They will say they are operating cash flow positive because of government grants and tax incentives, but I disagree with that. I think I don't. In my opinion, I don't agree that government grants and tax incentives should be in the operating section of the Appendix 4C, because if you just have a look at the bottom line, the company is operating cash flow positive. Wow. But they're not really. Anyway, so this means this is a storage stock. And the next important thing is when it comes to their trials. Where are they when it comes to their trials? Phase 1, Phase 2, Phase 3. I did have a quick look at this before I started recording. I didn't see any words about Phase 1, Phase 2, Phase 3. So there's a lot of things I don't know about this company. So I would say right now, Amna, that you know way more about this company than I do, because there's way over 2,000 companies on the ASX. There's no way you're going to know everything about every single company. It's an impossibility. In fact, if you have a look at or watch AusBizCall or something like that, on occasion you'll see a company mentioned and the the expert will say, I've never heard of this company before, which I do think is weird. If I was in their positions, I would know every single company, but I sort of understand it, particularly for those companies or those experts who focused on, big or blue chips, profitable blue chips. They don't care about these sort of companies. They don't care about Noxopharm. They wouldn't even look at it. Wouldn't even given a second thought to look at it. So anyway, so that's my opinion on Noxopharm. It's going down because of general uncertainty in the market. The reason I said that is we have a look at the announcements. They haven't released anything significant this year so far, except this SKN passes required in vitro safety test. It doesn't sound that exciting. So let's have a look at the chart for Noxopharm. So I'm assuming share price is going down. Yep, share price is going down. It's just overall negative sentiment in the market, I'd say. And the other thing to mention, or look, notice here is the share price took off back in October 2023, and since then we've seen share price go down, then up and go down. So it looks like it's trading in a range between about 6 cents and 15 cents over the last 2 years. And that's probably all I got to say about Noxopharm, but thank you for that. And Ma133. By the way, they have something to do with mRNA or something like that. I don't know. Roger Dawn, hi Kneppy, good content again. Wondering if you could look at WLD when you get a chance. Looks like they might be moving out of the Doldrums for a brief moment. I thought this was Woodside, but then I noticed it's WLD, which I think is Wellard. Is it Wellard? It is Wellard. And this is a shipping company, ships animals like cattle overseas. I could be completely wrong. I think it is. Return of capital. Did they sell a ship? I have a feeling they sold a ship, Sale of Ocean Drover. I still remember that because the share price popped up significantly on that day, 14th of January 2025. I will be honest with you, I don't really look at this company. I haven't looked at this company for many, many years. I just don't like this sort of company, that sort of thing. They don't release Appendix 4C. So we can have a look at the most recent half-year results. So obviously they're doing a return of capital because of the sale of that ship. I'm pretty sure this company's share price dropped a lot, maybe 3, 4, 5 years ago. Revenue, they mentioned, this is listed in US dollars. So revenue is $14 million, loss making. There's a ship. I'm just going to make sure it's cattle that they mostly ship. I could be completely wrong. Typically, there will be an about section somewhere, but I can't see it. But definitely, they do have mentioned. Oh, there it is. Of the 82,000 head of capital loaded globally during the period, our vessels recorded success rate of 99.9997%. Yeah, Wellard loaded 6 cattle voyages to the following destinations. So, yeah, what they do is just not that exciting to me. And so loss making, let's have a look at the operating cash flow. Operating cash flow negative. They did get $11.8 million from the sale of property, plant and equipment. So that did help. Anyway, so overall, not that excited about this type of company. So typically I just move on. But let's have a look at the chart. And remember, they made that sale, and I'm pretty sure that surprised the market and the share price popped up. Yeah, there it is. Massive pop-up in the share price on that day, 105.48%. And the share price has gone up since then. So that has been generally positive to the market. However, there is a return of capital. And this return of capital must be happening soon. Or maybe it's already happened. 15 cents per share. Oh, it's the 5th of August. 5th of August. So it's a long way from now. I didn't realize it was so far from now. And that could be a reason why the share price is going up, because that's a pretty big capital return based off where the share price is right now. And don't forget, dividends or return of capitals are not free. So when this company does go X, not dividend, X return of capital, or X whatever you want to call it, the share price will drop by over 15 cents. Yes, the share price will drop by over 15 cents. So what you get in capital return, you lose in capital in the company. if that makes sense. Because if you think about it, the company is valued, say the company was valued at $100 million. So they have $50 million of cash, and they decide to give all that cash back to the shareholders. So in that one moment, what happens is the company is now valued $50 million instead of $100 million because they don't have that cash on hand. So the company is actually valued lower by the market than it should be because of the lower cash held by the company because it's been given to the shareholders. So anyway, so that's what I'm going to talk about when it comes to Wellard. Now on to a few replies to this one. SAF 99681 can't understand why Australian tech companies have been hit harder than all other sectors. They don't get hit directly by tariffs. Interest rates more likely to fall if recession occurs. Obviously, recession hurts most companies, but not tech companies particularly. And there were quite a few responses. Just James Dean said, way overvalued. In fact, that would have been my main response, is when you compare Australian tech companies to United States tech companies, for instance, we are actually overvalued. We are, for some reason, the Australian investor values tech companies way more than American investors. It's weird. So have a look at WiseTech, P ratio 100. Have a look at like Altium when it was listed, P ratio was really high. Prometheus P ratio really high. And I think one of the reasons, and this is sort of an argument I have heard, is there's less tech companies on the ASX. And so if you want to invest in tech companies, you have a smaller pool to choose from compared to the United States. So that will raise up the prices of those companies because you have to pay for a premium. So let's see if anyone mentioned that. Jason Wiley, US tech companies are much cheaper than Australian tech, plus there is much larger choices. There you go. Thank you, Jason Wiley. I agree. Also, I agree with Kneppy's point that it's less about risk. It's more about uncertainty. If you're familiar with quant analysis, like copper, if anything, the demand for copper probably just doubled overnight. If you consider the simultaneous restrictions on supply and demand, etc., bounce could be incredible. Yeah. Brokers will be making a fortune. Brokers love these time of days because, yeah, a lot of action happening. Anyway, so I definitely agree with Just James Dean, overvalued, and Jason Whiteley that, yeah, there's more choices in the United States and US tech companies are cheaper. Have a look at Alphabet. Have a look at, I think it's the P ratio of Alphabet might be below 20. If the P ratio of WiseTech was below 20, it's not going to happen. It just won't happen. So that's the reasons why, in my opinion, and also some other people's opinion as well. Just James Dean mentioned Flight Centre has a horrible trend killer. Opposite of trend killer is trend starter. That's a good one. I haven't thought about that. Trend killer, trend starter. And this is something I'm looking at more and more is this could be a trend starter. Yeah, it's a great bit of insight from Just James Dean. I've been talking about trend killers now for maybe over a month. Something I am been noticing a lot, that when you see these one day significant change in share price, either positive or negative, it can shift the trend and shift the sentiment. And Flight Centre, let's have a look at Flight Centre. I don't think Flight Centre is in my list of trend killers, but let's have a look. Oh, yes. Well, so this is interesting. So I've just been looking at companies who have been in uptrends or downtrends, and then they get this one shock to the system, and that can shift the trend. But what I haven't been thinking about is when the share price has been doing nothing, going sideways, you get this shock, like we saw with Flight Centre on the 18th of October. Share price dropped 20% on that day, and that was the start of a downtrend. So, yeah, trend starter. So, fantastic start from Just James Dean. This is why Flight Centre is not in my trend killer list, because this wasn't a trend killer, it was a trend starter. So definitely something to keep an eye on. When you see these sort of candlesticks, so these red candlesticks, solid red candlesticks, that's not going to be good news. And you notice the share price didn't really just go down immediately. Sort of the share price went down on that day, but then there was a little bit of selling after that. Then there was a bounce. Share price sort of fluctuated a little bit, and then the share price collapsed when they probably released their results. Yeah, so this sort of company, even if the share price drops a lot, I don't even think about buying. Maybe shorting, but not buying. And that's why This is sort of the opposite of a breakout. So I'm looking for is a breakout when the share price pops up on good news. This is the complete opposite. So thank you for that, Josh James Dean. Trend starter. Yes, I probably would look at this as well. Trend starter. So the opposite of a breakout, which is what I'm looking for every single day. Okay, killer name says, do I still own HGO, which is Hillgrove? No, I do not. I sold out that a long time ago. Maybe not a long time ago. Time is a weird thing. And what I might think is a long time ago might be only like 2 or 3 months ago. Trend down. I didn't like some of the updates from the company. I thought, we saw copper go on a bit of a run. Hillgrove share price did not go on a run. It went the complete opposite direction. That is not a good sign for me. If I see a commodity price going up and the share price of a company mining that commodity going down the opposite direction, that's not a good sign. That is get out and find something else that is running. So Hillgrove Resource, in my opinion, at this point in time, is being disappointing, really disappointing, and I am out of this company until I might get back in if they start to do the complete opposite. If they start to excite me, is that the right word? If they excite me, intrigue me, if they impress me, that's probably a better word. If they impress, that's probably a better opposite word than disappoint, impress. Okay, this was an interesting one. Bob Jackson. So I didn't want to get too political in this video, and I'm going to try to stop being too political in most of my videos, but this is not really a political comment. This is more of a philosophy comment. Maybe not philosophy. Anyway, Bob Jackson says, Trump tariffs won't do as much damage as the Labor government has done and will do a lot worse if re-elected. My answer to that would be why? What policies have the Labor government implemented that has done damage to the Australian economy? And what policies moving forward do they have that will damage the Australian economy? You need to say why. You can't just say this sort of comment and that's it. Why? I am a policy person. I don't have any affiliations with any political parties, but I focus on policies. And I mentioned this. One of the reasons why I could not vote for a coalition is because of Dutton's stance on working from home. Now, they have shifted now. They have shifted that, and obviously why. But there's a lot of other policies that are a little bit too similar to Trump. So I could not vote for that party. But on the flip side, I've been highly disappointed with Labor's policies. It's not economy-destroying policies, but a lot of policies I've been thinking about that sort of thing, which I've been going, no, you had a great chance to change stuff and you just haven't done it. And then when it comes to Greens, very disappointed with some of their stuff that they've come out, like focusing or attacking Woolworths, that sort of thing, and not understanding return on equity and that sort of stupid stuff. I think they were attacking Woolworths because of their high return on equity and not realising they should be looking at margins, something stupid like that. They lost a bit of credibility to me. And for me, there's just no one to vote for. I'll be honest with you, there's just no one I like. And that has been true for a long time. I want a politician, a party to come in and try to implement stuff, implement policies that is going to have a meaningful change to the country as a whole for an extended period of time. And I just don't see it. So when you write a comment like this, why? What policies have led you to believe that this particular government has destroyed the economy? Or is destroying the economy. In fact, Chris Murphy just mentioned, what damage have Labor done? Yeah. And I think the problem with this sort of thing is so many people have affiliations to their parties, and sometimes they will contradict themselves because a party might change their philosophy on something, and then the person will just change based off what the party does. It's ridiculous. In fact, I have heard people say, I don't like this policy, and then when they realise it was their own party who implemented this policy, they will change their stance on this policy just because they realise that's what their policy wanted. So I just don't understand why people just stick to a party and just believe everything they do. Every single thing they do. It's sort of like if you love a band, like a music band, and you just love every single song they do, no matter if it sucks or not, because the band released it. I'm not like that even with bands. So I have my favourite bands, but I don't like every single song. In fact, I hate some of their songs. But just because I might not like a band doesn't mean I'm going to dislike all their songs. I might like one or two songs. In fact, that has happened. I'm not the biggest fan of Britney Spears, but I do like one of her songs. That's it, one of her songs. But anyway, so what damage have Labor done? Just James then says superation ripoff coming. And this, what does this mean? I would be more concerned about Liberals and them saying people can dip into their super to pay for the housing. I think that is a horrible policy, absolutely just terrible policy. And Solar Aquarium, Labor have proposed taxing unrealised capital gains. I don't think that will ever go through. And if it did get through, I would have a major issue with that as well. Immoral and very stupid. Yeah, I agree with that. That sort of taxing unrealised capital gains, I do think they have that in New Zealand. Do they? And I think that's a stupid policy. Stupid policy. Anyway, so that's all I'm going to speak. I do have one more sort of political statement, but I think, no, that might be it. That might be it. Maybe. Anyway, nice 007420 says, any tips about how to start buying again? Use a chart for golden crossovers. Definitely looking at crossovers. But when it comes to start buying again, I think this comes to your own personal preference. I can't give you any advice, that sort of thing. So what am I doing? Now, these are still fairly uncertain times. So, for instance, overnight, NASDAQ went up 1.89%. And if you have a look at the chart, still in a downtrend. We're still in a downtrend. I did see this, was it podcast I was going to listen to? What was it from Livewire? It was Livewire. Where is it? Did I delete it? I must have deleted it. Which we no, we're not. Yeah, no. This is with Emma Fisher, who was I forget who she was with, and the title of this particular Rules of Investing podcast is "We're Buying." Emma Fisher spots a rare chance to upgrade the portfolio. She mentioned that after the ASX plunged more than 6% in a single day, soft signal that the worst of the panic may be behind us. So I think that's a little bit premature because there's still a lot of uncertainty out there, not only when it comes to tariffs, but also when it comes to the economy. So this could be the start of a massive bear market. We just don't know at this point in time. So I'm not rushing in buying companies I think are cheap. I'm going to be a little bit more selective when it comes to trades and those sort of companies. But eventually I do think there will be a time when we should start dipping in. Now, that's me personally, but I could be too late. But it's okay. If the market rallies from here, I'm fine with that. But there is a chance the market might fall from here. So we are getting some signals. It's all become when you're comfortable buying back in. If you find a company you like that looks really good value, that is a good time to buy that particular company. So it is all about personal preference and context as well, I think. VBE D66. I was thinking I've answered this, but I'm not sure if I did. Either I answered this in a video or I was thinking about this, and I might not have answered it in a video. This comes to a company called Birddog Technologies who are doing a share buyback, and a very good point from VBE. So if Birddog Technologies are burning through cash and are not profitable, where is the cash going to come from to do the share buyback? Also, if there is a requirement in the future for more funding, share placements or new share issues are not an option if they aren't listed anymore. This Birddog delisting doesn't make sense to me. It doesn't make sense to me as well. But they decided to do a share buyback at the same time as they mentioned they're doing the delisting, and that really helped their share price. So the question comes, where are they getting the cash from? Because they're burning through cash and they're not profitable. So that is a big question. If they were doing the share buyback and they weren't delisting, I would think this is the worst move a company could ever make. So what I'm going to do is just have a look at the most recent. I'll go to the operating cash flow or the Appendix 4C. It's just because I like this over the Appendix 4D. And yeah, so they're burning through cash, $1.7 million of operating cash flow outflow in the last quarter, $5 million in 6 months. So they're burning through a lot of cash. So doing a share buyback is not good for the company. It's good for shareholders who are holding on to the company before they delist, but it's not good for the company overall. Anyway, so Here's how much cash they have. So $9.7 million of cash, and they're burning through, we'll say between $1.5 and $2 million of cash per quarter. Now that could improve. That could improve in the next quarter. In fact, I could be a little bit being optimistic about that. Conservative, the opposite of conservative, because they're burning through $2.5 million of cash in operations per quarter in the last 6 months. So that means if you have a look at the cash on hand and how much they're burning through cash, they've got 1 year or less than 1 year of cash on hand. So what are they going to do when they delist and they need cash? They're going to burn it all through it doing a share buyback and just in operations. So where are they going to get the cash from? Yeah, that's a really good question from VB. Where are they going to get the cash from? They're no longer on the equity market. And the whole reason you list on the stock market is much easier access to capital, much easier access to cash, which you might need because you're burning through cash. So it just doesn't make sense, this particular delisting. I understand why they're doing a share buyback to make the delisting seem a little more attractive and allow shareholders to get out. But I think it's not a really good decision from management in the long run. In the short run, yes, for shareholders, they're looking at shareholders, but in the long run, no. So absolutely agree with VBED66 right there. And when I say what they did was really good, it was just for shareholders in that short term. Because what could have happened is the share price dropped 30%. Otherwise, if they didn't do the share buyback, which would not be a good thing for shareholders. Okay, on to Raven. Raven. If we get Wall Street Trank tonight, the bots will run. Late night for me. Gold ETF stock. So the reason why I've included this particular comment is because of gold ETF stock. I was thinking, what gold ETF stock is there? And I'm pretty sure we have gold. I'm pretty sure the ETF is just gold. Yep, it's gold. Global X Physical Gold ETF. And I'm pretty sure this particular ETF has been doing wonderfully well. This is sort of the route I might take when it comes to ETFs. So I'm not a big ETF person, but this is sort of the play I would look at in the future. Instead of buying gold companies, is that the right ETF? 47.45. Yeah, this is the right ETF. Instead of buying individual gold companies, and some of these gold companies' share prices are going the opposite direction. Look at this chart, a beautiful chart. So this is a really good potential play on gold. If you're very bullish gold, yeah, so you might get more leverage out of a good gold companies. I think the share price of those companies will rise significantly more than a gold ETF. So this is more of a conservative play, but definitely, yeah, definitely it's a definite option for me. A gold ETF on the ASX. So thank you for that, Raven. I'll forgive you for saying Wall Street Trank. So I'm pretty sure Trank is not a word. Let's Google Trank. I could be wrong. And if Trank is a word, it is a word. Another term for tranquilizer. It's bad news missing Tranks with booze. I've never heard that being used before. But that's Oxford. So obviously that's a real word, Trank. I'm going to see if I can use it in Wordle tomorrow. Trank. It's going to be a word. No, it's got the K at the end. I'm not going to use it. It's got the K. Okay, on to, another one from Anma. So Anma's been a bit lucky today. I've just dropped my pen. I need my pen to, Oh, Anma. How about EZZ? I think you mentioned it was very undervalued. I just want to clarify something. Potentially undervalued. I would never say something is undervalued or overvalued. I always say potentially undervalued or potentially overvalued because there are scenarios where you could be wrong. You might be wrong. For instance, you might see a company who has a P ratio of 100 and you might say, well, that's really overvalued based off the P ratio. And then the company increases their profit by fourfold, which would mean the P ratio would be 25. So, would that mean it's undervalued? In fact, overvalued, I'd say it's potentially undervalued if the company can quadruple their profit and then maintain that sort of growth. The company would be really cheap. So the argument is, or the question is, how do you determine whether a company is undervalued or overvalued? And even then, you might be wrong. So EZZ has the potential to be very undervalued, but the market is seeing something that I might be missing. Because if you have a look at the chart, Share price has just been dropping a lot. I don't know why. Now, you can see the massive rise in the share price from April last year. So you can notice in 1 year's time, the share price of this company has gone from 50 cents all the way up to $5, so 10 bagger, and on all the way back down to $1.46, all in 1 year. Anyway, so what's been happening? Nothing. Company hasn't released anything negative, in my opinion, but this could be just a little bit of negative sentiment. Share price up 10.61%, by the way, on Friday. So this could be a sign the market might be seeing something, might be seeing a little bit of value in this company. Now, the reason why I would say this company could be undervalued, I might have a look at FinChat. Actually, I'll have a look at the most recent, so the market cap of the company is, it's not that high, 68 million. They also have about $20 million of cash. So enterprise value is below 50 million. So if you have a look at the most recent, say, results, half-year report, the one thing I'd like EZZ to do a little bit more is selling the company, sort of like Biome does. They always do these little trading updates. I'd love to see that from EZZ. All they do is release financial reports and on occasion some other announcement. Anyway, so revenue of $30 million and they had a profit in this half year of $3.2 million. And if we go to FinChat and have a look at their financials, and what we'll do is we'll have a look at the semi-annual financials and look at revenue. The company has been increasing revenue. And you can see a bit of a decrease from the second half of last year to the first half of this year, but there is a bit of seasonality to this company. We saw that in 2023 as well, not as extreme, the drop, but I wouldn't be surprised to see a really big increase in revenue in this particular half year. And the reason behind that is they are focused in China, and China, for some reason, there's a lot of buying in China this time of year, or in the first half anyway. But the most important thing here is the income. So in the last 12 months, the company has had a profit of $9 million. So remember, the enterprise value of this company is 50. So they're currently trading on 5 times enterprise value. That could be cheap. Now, if we go back to say, so P ratio 6.3, price to book 2.5, EV to sales 0.7, EV to EBITDA 3.7, which is really low. In fact, someone could acquire this at enterprise value to EBITDA of 5, and that would be cheap. Price of free cash flow 8.7. So there's a lot of metrics that are screaming out very cheap. But the market is obviously seeing something they don't like, or the market could be overreacting to the downside, and that always happens. And which one is it? Don't know. But I do have a holding in EZZ. I was trading it. I'm not trading it anymore. But if I start to see a little bit of change in sentiment in the trend share price, I would trade this again. And then what I would do if I start trading this again is I'll take most of my profits and then put that into my long-term holding. And that is what I like to do when I am trading companies, if I hold some companies for the long term. And the reason I'm holding EZZ, even though the chart is in a downtrend, is because I think there might be some really good value. I think this company could be significantly undervalued. Again, could be, potentially. Dev Shaw says, what are your thoughts on Woodside and Karoon? Based on the past dividends, you reckon it's good value at the current price? Okay. First thing of all, Woodside and Karoon are not high-quality companies because they're mining oil or gas, and they are commodities, and commodities can go up and down based off supply and demand, sort of like iron ore. So I never consider Woodside and Karoon to be high-quality companies. So therefore, I would trade these companies, and that's about it. I would never own these companies for the long term. And there's one simple reason. Now, oil has gone sideways over the last 20 years, and we know this because we can look at the chart. I've got it somewhere here. Here it is, oil. We have a look at the weekly chart. Oil has done nothing for 20 years. In fact, back in 2007, 2008, oil was at a higher price. So oil is just not doing anything. It's trendless. And if you have a look at Woodside chart, now people would say this is more of a gas company than oil. It's not the same thing. But if you have a look at Woodside's chart over the last 20 years, it's done nothing. sort of very similar to oil. Done nothing. So this is not the sort of company you want to own for the long term. Now, in saying that, you do notice back between 2003 and 2007, share price went on a massive tear. Share price went from $12 to a high of 67. So definitely, if there is some tailwinds behind the company, share price could turn around. Now, the share price of Woodside is getting to interesting levels. So we're seeing the share price get down to close to what we saw back in 2020. So it is possibly at interesting levels where I could see a bit of upside. So sort of like the same thing when I was talking about IPH, I could see some capital gains from here. So even though I would not consider this company to be high quality, I definitely could see some capital gains. And I'm talking about 100% gain from here, just with capital growth. So that's not even including dividends. What's the dividend yield for Woodside? So dividend yield, according to FinChat, it's at 9.8%. So I'm not even going to look at revenue growth, earnings per share growth. It's all over the place. In fact, revenue growth has been okay over the last 10 years, but earnings per share has been up and down like a yo-yo. Dividend growth is actually over the last 10 years has been negative. Last 5 years positive. Last 3 years negative. So you're going to see dividends of this company just go up and down like a yo-yo. So I wouldn't rely on the dividend and dividend yield, but I do think there is potential upside when it comes to Woodside just because the share price has dropped a fair bit over the past year and a half. And I would say the same is true for Karoon. Actually, the other thing I'm going to do is have a look at oil. Go back to oil. It did drop below $60. I do have this purple box. I thought that would be a nice little support level for oil. Last time oil was at this levels was way back in 2021 when oil was in a beautiful uptrend, a short-term uptrend. That uptrend lasted for maybe a year and a half. Oil went from $36 up to $124. So that was a good time to be invested or trading oil, not now. But is this the end of the downtrend, short-term downtrend in oil? Now the question becomes that if we do go into a recession, maybe a deep recession, possibly even a depression, there will be less demand for oil. But then we also have OPEC and that sort of thing. So who knows? It's one of the reasons why I just stay out of oil, but I am willing to trade oil companies on occasion. And in fact, I am trading Karoon right now because I do think there is potential value when it comes to Karoon. And I'm sort of near there when it comes to Woodside as well. So Karoon about $1.25, could be a double bottom there with Karoon, and looked like the chart was turning positive. But then we had this tariff war and share price has dropped. But when you have a look at Karoon, I think this is a really intriguing value play. I don't think you're going to get much. Yeah, you're not going to get much here. It does mention the PE ratio is at 4.8, but there is definitely an argument that Karoon is really good value at these levels. But for me, it would be more of a short-term to medium-term trade, just looking at the chart. So thank you for that. Yeah, good value. Yeah, I think there's definitely an argument that there's good value. Does Karoon have a dividend? According to this, they do, 12.7% dividend yield. Let's just confirm that with ComSec. They had, a final dividend of 5 cents, interim dividend of 4.5. So we're talking about a dividend of 9 cents. So it's not quite as high as that. It's more like 7% or so. Anyway, so there's potential value for both these companies. So yes, I sort of do agree with Dev Shaw. Not sort of, I actually do agree. Okay, I think I've already answered this in another video, but we did get a few questions about Technology One. First one was from Chris119, and we also had another question about, here it is, Trader Hooper. I confused myself with the 200 EMA theory and thought Technology One would be a good buy around this level. Now I realize it's a 200-week moving average and not the 200-day yes that Charlie Munger was talking about. It makes a huge difference. I'm glad you covered this a few times, so at least now I'm finally got it. So in my opinion, and I'm going to, even though these are questions about Technology One, they do, Trader Hooper has raised something very important here. So let's talk about my professional career. So I was in a place called University of Brockport, SUNY Brockport. SUNY Brockport, that's where I got my meteorology training, or most of it. SUNY Brockport, just to the west of Rochester, New York. William Fichtner, most famous alumni. He's he's sort of a semi-famous actor. Yes. Anyway, so beautiful, wonderful area, in my opinion. Wonderful area. Rochester is very famous for being, what do you call it? Civil rights. So Frederick Douglass is buried there, and also Susan Adams, which is women's rights. She's buried there as well. So a lot of that sort of forward thinking came out of Rochester area back in the late 1800s. So very nice area, wonderful climate, except if you don't like a lot of snow during the winter. And I just went there because I was attracted by, well, they had a meteorology degree and also the area. Now, one of the things I realized when I was going through my training back then is they'll throw a lot of concepts at you. They're continually throwing concepts at you. And a lot of times you just don't understand it. And then what I realized after a while is you got to see these concepts another number of times before you really start to understand it. Sometimes it can take as long as 3 to 5 years to understand a concept. And then all of a sudden the light goes on. You go, oh, yes, this makes sense. So it does pay to mention something continually, because it might take some people a long time to finally understand the concept. So I will never be hesitant about mentioning something over and over again, because sometimes it takes a while for the light to go on. Anyway, so this Charlie Munger 200-week moving average, I actually did Google it once, 200-week moving average Charlie Munger. So I was actually dubious that Charlie Munger would say something like this. But there's a lot of stuff out there that, Charlie Munger, if all you ever did was buy high quality stocks on the 200 moving average, you would beat the S&P 500 by a large margin of time. Now, I want proof that he actually said, there's my videos. I want some sort of proof where he says it or he writes it down. I haven't actually got there just yet. But anyway, in fact, in the NASDAQ website, Charlie Munger, buy quality stocks at 200-week moving average. But I want somewhere where he says this. That's probably my next step. Anyway, so and I've been looking at this. Once I heard this, I went, this might make sense. And I've been looking at it more and more, and it does make sense. And I think this would be a great strategy, a very simple strategy. The only difficulty is understanding or trying to figure out whether a company is high quality or not. I think that's the trickiest thing about this, because otherwise a very tricky strategy, very good strategy as well. And I've now been using it. I wasn't intentionally using it. And then I realized in 2022, I was using it, not perfectly, but definitely using it. Now let's have a look at Technology One. I think I've already answered Technology One, standalone video, not a standalone video, but during the week. I think I did. And if you have a look at because the share price did drop below the 200-day moving average for Technology One. And funny enough, if you do have a look at the 200-day moving average, it does hold as a nice support level. Now, the share price of this company has been going sideways at times. Yeah, it went sideways for a long period of time back between 2016 and 18. So it doesn't really work at that point. But if you do have a look at the 200-week moving average, it holds as a pretty good support level. Consistently above that level. It fell briefly during 2018, very briefly during that stock sell-off. Oh, that was June. That was a great time to buy. I missed it because, and right now the share price is still well above the 200-week moving average. So, I wouldn't consider Technology One to be overly cheap at these levels. In fact, I'd still consider Technology One to be quite expensive based off historical PE ratios and that sort of thing, or valuation metrics. Monogram 63 says something about Polynovo, and also have 2 questions about Polynovo. And for some reason, I have to go back. But I do have two questions about Polynovo, and it looks like I missed one of them from SAF. We have one from SAF 99681 and one from Monogram. But let's answer Stu Percy's. Do you have any thoughts on Marcus today? Maybe I can answer this tomorrow. So maybe I can give you my thoughts on Marcus tomorrow. Which Marcus are we talking about? Marcus. Let's find out who is the most famous Marcus. Let's just Google Marcus. Marcus Goldman, Marcus Buckingham, Marcus Aurelius, Marcus Mariota, Marcus Freeman, Marcus Aurelius. Would this be the most famous Marcus in history? I have no idea. So I can give you my thoughts on Marcus Aurelius today. Now, I'm joking, of course. So Marcus today is an investing, I don't know what you call it. I'm pretty sure Henry Jennings is one of the people in this. Our members, our team, Marcus. So those who like Henry Jennings, there he is. Henry Jennings, Marcus Padley, that's right, the name. I don't know anyone else here, I don't think. Or they're fairly young, aren't they? Emma Padley, I wonder if she's married. Maybe it's her sister. So the senior analysis and editor analysis, they look fairly young. Marketing communications, Jemima Padley, I wonder if she's the daughter. And Cameron Duffy. My thoughts on Marcus today. I do get a lot of emails from Marcus today. I've never been a subscriber. I do get emails. I like the reads. I do like Henry Jennings. I do like his philosophy, that sort of thing. But I've never used their resources because you do have to pay, member's guide. So I've never been a member, never really looked at, gone further into what they're like. I did notice the other day that Marcus Padley was really emphasizing they went 200% cash. They really topped the market, hit the bottom or the top of the market, and there was a question about whether this is the time to buy or something like that, which is interesting. They've gone 100% cash. But it was interesting because elsewhere in the email, they mentioned that they must have quite a few portfolios because they didn't mention the 100% cash in those other portfolios. So I think there was a defensive portfolio, income portfolio, and they should not be in cash if they're talking about income. So I'm not sure what sort of portfolios they do have, but I do like Marcus Padley and Henry Jennings, but I have never subscribed to their site. So, yeah, so I have no problems with Marcus Padley and Henry Jennings. Oh, Trader Hooper. Oh, no, I've already answered that one. Sorry, I've already answered that one. Now on to Polynovo. So we have Monogram, and there was another one which I'm just going to look for now from SAF 9961. Hopefully it comes up. Here it is. Surprising negative reaction to Polynovo announcement, which I thought was positive overall. And let's go back to response status. I responded. Apply. And this makes it really easy for me to look at your questions. And Monogram says, I understand Polynovo's chart looks good, but at this price, do you agree this could be attractive with good ROE? So one of the reasons why I decided to talk about Polynovo was just because there was two comments about it. Yeah, it's as simple as that sometimes. A Polynovo chart looks bad. So we'll start there. It does look bad, doesn't it? It looks horrendous. So this is the weekly chart. But even though the daily chart looks bad, one of the things I like to do is just I like to have a look at support levels. So Polynovo is at a support level. Support zone, we'll call it, which was the lows we saw back in 2022. Got close in October 2023. So this, and notice there's some being really good volume coming through. I would have liked to see some lower volume and then some big spike in volume in the last week. That would be an indication that maybe we're at the bottom. So there would be questions about the valuation of this company. The chart looks pretty horrible, but wouldn't be surprised to see a bounce, particularly, oh, by the way, we have seen some pretty big volume coming in during the week. So that is exciting, but massive volume coming in. So I would say a lot of those who wanted to sell out probably have already sold out. And Polynovo does have a high market cap, 737.75 million, but they are profitable. So this is exciting. Polynovo is profitable. I wonder if we see that. The return of equity, return on equity might be, it says negative. That's 5-year average in FinChat. So I would have thought I probably would ignore return on equity for Polynovo because their profit would be fairly low and their equity is fairly high. So I would be surprised if their return on equity is high. So what is it right now? Return on equity. Well, where is it? Capital efficiency. Return on equity is at 8.2% last 12 months, latest 12 months. So it's not that high. And the reason behind that is if you have a look at the income statement, so profit is at 5.9, which is fairly low. That could double, triple, quadruple in the next few years. And their equity must be, you have to look at the balance sheet. And their equity must be, say, 500, 600 million. Oh, no, 50 million, sorry. 75.5. So if you just imagine the company I could definitely see this company we'll say doubling. That means the company's return on equity starts to look really good. If the company tripled their profit, the return on equity looks even better. So we're talking about return on equity of like 20%. Wait, then it's even more than that. 30%, maybe, not quite 20, not quite 25%, just below 20% or 25%. So that's the problems with these sort of companies. That just in profitability, some of these metrics look quite small. So return on equity looks smaller than I think they will achieve if they continue to grow. And this company is growing. The reason we know they're growing is because if you have a look at their revenue, let's have a look at their revenue. By the way, gross profit margin at 86.4, that's pretty nice. So the importance of gross profit margin is it gives a company more flexibility in what they do. So they could decide to spend a lot of money on sales and marketing and that sort of thing. So operating margin at 5.8%. So they do spend a lot of money in selling, general and administration. We don't have what they do here. But anyway, so revenue is increasing. Yeah, look at the revenue increase. Beautiful increase in revenue. That's the first major step for me, and they have become profitable. So they have hit that inflection point. So these are interesting times for Polynovo, and it's not surprising to see this much volatility because it's hard to value. It would be hard to value Polynovo because if you do a DCF, your assumptions could be all over the place. So it's not like a company that is mature, growing at a persistent rate. If you do DCF for that, everyone who does the same DCF is going to get similar ranges of outcomes. With Polynovo, you could do DCF one day if you're feeling positive and get maybe a valuation of, say, 2 or 3 billion. And the next day, you might be feeling a little bit more negative and get a valuation like 500 million. So you're going to have valuations all over the place when it comes to companies like this. But the share price is an interesting level and the company is profitable. And I would say the company will grow their profits at nice rates over the next 5 years. So this could be a good time to buy some shares in Polynovo. Oh, I did the same thing. Oh, I know what I did. I did this earlier, not in this video, but I must have clicked on an individual video, yeah. Okay, so thank you for that monogram. Does that mean we're near the end? Oh, no, Forest Hill. Forest Hill, being pedantic. No, you're not. I didn't even think about this. I just put is the worst over without thinking that it should be worst, not worse. The funny thing is I am a bit of a pedantic when it comes to loose. So people spell lose, the opposite of win with 2 O's. I absolutely hate that. That is a bugbear of mine. So loose versus loose. Some people don't know that loose and lose are completely different. And it's rampant. That's probably the reason I hate it. If one person was doing it, I wouldn't care, but it's just rampant. The opposite of win is lose with 1 O. The opposite of tight is loose with 2 O's. Now, the worst thing is, if this keeps on happening, eventually it will become normal and eventually it will change. Our spelling will change. Where lose, the opposite of win, is spelt with 2 O's. That is how languages changes over time. If you have a look, oh, gee, what was it? I was having a look at this the other day. It was something that was published in 1590s, and I was trying to remember what it is. I can't remember now. I still remember it was must have been some sort of playwright, because I was talking about a contemporary with William Shakespeare, and in the particular title of this particular thing, words were spelt with U and V's. Now, back then, a U looked like a V and a V looked like a U. In fact, I'm going to see if I can. I can't remember what it was. U's 1500s. U's looked like U. I should put U looked like V, and V looked like U. See if I can get. Well, there you go. Letters U and V were not considered distinct letters, but rather different forms of the same letter. V was commonly used at the beginning of words, while U was used elsewhere. This practice continued until the 1630s, when the modern convention of using U's for vowels and V for consonants was introduced. There you go. I just think there was no different. I was trying to look at an image where we saw this. Yeah, there was. I just remember this the other day. I was looking at this. This book published in play published in the 1590s, and the only difference between their English and our English was the use of U's and V's. And thank you, AIV Overview. Anyway, so thank you for that, for I Still. You don't have to apologise. Alan's Memories of Nothing ends 8029. Do you live near the beach? Well, it all depends on what you define as near. Now, in terms of the size of the universe, we all live near the beach, because the beach is just a little bit away, just a small smidgen away. Now, if the size of your universe is like your backyard, then the beach for me is a long, 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 long way. So, for instance, if I was an insect, an ant, the beach would be a universe away. Do I live near the beach? In my opinion, a beach has waves, so crashing waves that you can ride on surfboards or boogie boards or on your body. For me, that is a real beach, like a beach at a lake or a beach at a Moreton Bay. They're not beaches for me. The beach in South Bank in Brisbane is not a beach. Remember, they have this sandy lake, whatever, not a beach. So a beach needs waves you can ride. So in that terms, I don't live near a beach, because I'd have to drive about an hour away to get to the nearest beach. And for me, that's not near. It's one thing I do miss. My favourite place living in Australia, and a lot of people who hate Sydney are surprised by this. So there's a lot of people who hate Sydney. Oh, Sydney's an awful place. My favourite place I've ever lived in Australia has been in Sydney. I lived near Coogee Beach, and that was amazing. Going to Coogee Beach all the time. My favourite place in Australia that I've ever lived was near a beach. Anyway, and the last comment today or question is from VBE D66. I'm a sharer of Monash. How did I respond today on the negative news? I purchased more shares and doubled my holding at a bargain discount price. At the end of the day, Monash of a high dividend yield, money for jam, regards. Okay, so different philosophies here. So I will never say negative about this sort of philosophy of saying, hey, this company's share price has dropped a lot. I think the market is overreacting. This company has a nice dividend yield. And sort of the same thing I was talking about when it comes to IPH. I think if you can grab these companies with a nice dividend yield, with potential really nice capital gains in the future, you're going to get double, maybe not double your money, but you're going to get two good benefits happening at the same time. Capital growth and a nice dividend yield. I've never thought of Monash in that sort of terms. So let's have a look at Monash, MVF. I didn't even think about the dividend yield for this company. So let's have a look at the overview. Dividend yield is at 4.5%. I'll probably want that to be a little bit higher. To be frank with you, revenue growth, we're talking about 10% revenue growth over the last 3 to 10 years. Earnings per share growth has been decreasing. Why has earnings per share decreasing but revenue has been increasing? Is it margins or what's been happening? I'd like to find out why, but dividends per share growth has been increasing at 5% over the last 10 years. So that's a nice little dividend growth. I probably would prefer that dividend yield to be a little bit higher. But is that before that decrease in share price? And by the way, the CEO has the best name on the ASX. Not only that, his middle name has the same initial as my middle name. I am Michael D. Knapp. He's Michael D. Knapp. I'm just going to buy this company just because of the CEO's name. Anyway, so they have a little bit of debt, looks like. I'm just going to have a quick look at the most recent dividends. Now, another thing is the dividends could be affected. Now, one of the reasons why the share price dropped a lot is because the market's just unsure about what might happen. So according to CommSec, dividend yield is 5.2%. You can see how dividend had been decreasing between 2016-17 and 2021. Now, that does concern me. I don't like to see dividends dropping. I like to see dividends increasing through time. And the most recent dividends have been about 5.1 cents. So the dividend yield is getting close to about not quite 10% based off the last two dividends. So that's assuming that dividend stays the same, has been increasing the last few years, excuse me. There is definitely an argument that there could be a really nice dividend yield. And then there is also that potential of a nice capital gain as well. So the market might be overreacting. It might be, but there is a bit of uncertainty about what might happen. And if you have a look at the weekly chart, so I'll probably not consider this company to be high quality just because look at the chart. You don't see the share price is not going from the bottom left to the top right. And so for me, this would be more of playing the chart in an uptrend or maybe value. So I do look at things a little bit differently for these companies that might have a nice dividend yield. Is there value? Share price did drop to 37.5 cents during COVID-19. So I would say that's the floor on the share price, probably. Absolute floor. If the share price got to 50 cents, I'd be interested. Maybe. Anyway, that's all I have for this particular video. If you do have any questions, any thoughts, leave those in the comment section of this video or any other video. And don't forget, I am not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this one. Have a good day. Bye.